So we assume a return generating process of the form. This is the same basic form that you saw in talks on Tuesday. The return of your assets are phi factor returns times x, which are factor sensitivities, plus idiosyncratic returns epsilon. And we have n securities, k factors. N is typically much bigger than k, so n could readily be 50,000. K is more likely to be 10, 20, up to perhaps 100. T is the number of days, typically, in your estimation window. So you're going to run PCA on T days of observations. The covariance matrix of your factors is assumed to be the K by K identity matrix. That's really a normalization. And it's a reasonable one to do when you're looking at PCA. There's a parallel literature in finance that looks at what are called fundamental factors, and they're typically the factor covariance matrix is something other than the identity. The factor loadings are defined by having lots of people doing research and things of that sort. But when you're looking at statistical models, then you can assume without loss of generality that the covariance matrix of the factors is the identity. The way this works is to compute eigenvalues and eigenvectors. And I'm going to put quotes on covariance matrices everywhere because the covariance matrix, by definition, demeans the returns. And it works better with financial data if you don't do that. So everywhere, when I talk about covariance or correlation, I'm going to assume that we just take the return matrix times its transpose and not subtract off means. There are two matrices you could look at. So one is the n by n covariance matrix. That's the covariance of the matrix of covariances of asset returns. And alternatively, you could look at, instead of R transpose R, R transpose. That's a T by T matrix. And the interpretation of it is a little bit unclear. Okay? But it turns out to be very useful computationally, and I'm going to also observe that it helps solve a problem that will arise in this. So, and in addition, people look at various weightings. So for example, you might choose to weight the individual stock returns by the size of the market capitalization of that firm in order to focus the attention in the PCA on the shares that are most important in a typical portfolio. Okay, now it's partly for reasons of numerical efficiency that typically one uses the T by T matrix, since T is typically 250 or 500, maybe 1,000 at the most, and as I said, could be 50,000 or even larger. And so the T by T matrix is much smaller, much easier to do computation with. But they're closely connected. The two matrices actually have the same non-zero eigenvalues, and they have closely related eigenvectors. So in fact, if you're interested in the larger eigenvalues and the associated eigenvectors of the n by n matrix, you can get them from the T by T matrix. And I've said that. And the basic reason why we don't demean is that if you look at a year's worth of data on returns in the stock market, the sample mean of returns is going to be something not zero, not even particularly close to zero, but it's basically reflecting the realizations of the volatilities of the securities. And we actually know that the mean returns of stocks on a daily basis must be quite small, and it's better to set that to zero than it is to use a noisy estimate of zero. If you know the thing is very close to zero, better to use zero than to use a noisy estimate. Now, in talks I've seen about PCA, people are very focused on the covariance matrix or the correlation matrix from which the factors are extracted. And I want to argue that in doing that, we're actually missing something that's useful. there's actually more information in the return matrix R than there is in the n by n covariance matrix of securities, and we can exploit that information. So, of course, it's true that if you know the asset covariance matrix, then you know the eigenvectors and eigenvalues, and there's no additional information in return matrix on the eigenvalues and eigenvectors. However, this is the relationship between eigenvectors of the n by n and t by t matrices. X is an eigenvector of the n by n matrix, and that makes it a portfolio representation of an estimated factor. This is going to be a portfolio you could use that whose returns would replicate the given factor. Okay, and X is an eigenvector of the n by n matrix if and only if Rx is an eigenvector of the t by t matrix. And the thing to note is that because I've taken this portfolio, vector X, and multiplied by the return matrix, this is actually giving me the return of an estimated factor. Okay, so it's giving me an estimate of what the factor returned on each day in my sample period. And because of that, the eigenvectors of the t by t matrix contain information about the distribution of factor returns that you don't get out of the n by n securities matrix. It just isn't in there. I could look at a given asset covariance matrix, and I could assume the returns are Gaussian, but they might not be. They might be some kind of high kurtosis return, or there might be a skew in them. In fact, in financial returns, you do observe excess kurtosis, and you do observe a significant negative skew, and you would never know it. You'd never find it. But since in the eigenvectors of the n by n matrix, you've actually got estimated history of returns of a factor, you can actually ask, well, are these Gaussian, or do they show excess kurtosis as in a power law, or do they have a negative skew? So those are questions that there's information on those questions in the eigenvectors of the k by k matrix. Okay. Well, the statistical justification of LFE in most settings assumes that you're looking at a covariance matrix that's obtained from IID observations. Okay, there needs to be some kind of stationarity in the at least typical justification. So this is literature in economics and finance. It's an asymptotic theory in which t and n go to infinity, and because of that, epsilon, that's the individual idiosyncratic return of individual stocks, it's not explained by the factors, is not particularly important, at least for diversified portfolios. Should say that because these are asymptotic results, one of the real problems people have is getting finite sample results. They're very, very complicated to state and figure out, and in fact, we're always working with finite samples rather than in the asymptotic limit. So that's another issue in this literature. But the assumption underlying this is that the n by n securities matrix is converging in an appropriate sense. And that's where the misspecification is, because if you look at data from certainly stocks, but many financial markets, the most striking thing about it is that it is absolutely does not have anything like a stationary volatility. You get extremely volatile periods, you get relatively calm periods, you can get transition from one to the other. And if I'm estimating LFE with a year's worth of data, the most obvious thing if I look at that data is that the returns are not stationary over a period of a year. So what do we do with that? Well, you might think that just because the volatilities are changing, the underlying correlation structure is constant. And that's not true either. In fact, if you have fixed factor sensitivities, factor loadings on factors, and the factor volatility changes, that actually changes the correlations of securities. So the correlation matrix of the securities is also not remotely constant over the course of, let's say, a year. So an example is that if the market becomes more volatile, then the average correlation between securities rises. That's something that's been widely observed for a long time in financial services, and it's a problem because it says that when the market becomes volatile, in some sense, that's when you most need to control your risk. It says that the benefits of diversification, which are very real, you lose some of them. The benefit of diversification goes away to some extent. So variable volatility is obviously present, and I think it's widely understood and believed, but not quite so obvious from the data, that there are also significant changes in regimes. So an example, this is the example that's most commonly cited. If you look at the correlation between the price of oil and economic variables like GDP, gross domestic product, or the stock market, there are times when they're positive and there are times when they're negative. And the explanation of why is it depends whether the change in price is coming from a supply shock, so suddenly there's less oil being provided to the market, or because of a demand shock. So if the economy does well, the demand for oil goes up, and that can push up the price. And that has certain implications. On the other hand, if the rise in price is resulting not from an increase in demand, but from a curtailment of supply, that has completely different implications economically. So regimes are also important, and I've got in this paper some results about both of these, the variable volatility and also regimes, but most of it's going to focus on variable volatility. Anyway, the assumption that the n by n asset covariance matrix converges is problematic when applied to financial data. Okay, so there are two approaches in the literature to dealing with this. So one, actually there was a presentation on Tuesday, Shu's talk, and there's also work by Marcus Pelger, who is a student at Berkeley now at Stanford, looking at high frequency data. So you take not daily observations, but observations every 5 or every 15 minutes. And if you do that, then you can push up the number of observations, T, to a much larger number over a period of time in which plausibly the model is stationary. You know, so I said that there's no way that it's plausible that the volatility is an ID process over the course of a year, but you know, maybe it is over the course of a month, and you can push up the number of observations by looking at over shorter intervals. And this is in fact a very good solution to the problem in some cases, but not in others. Where doesn't it work? Well, where it does work well is if you have the stock market in a single country like the US. And so therefore you've got reasonably synchronous observations at 5 or 15-minute periods of the returns on most of the stocks that are traded in the US. But if you're trying to form an analysis of a global portfolio, you can't do that because the times when the New York market is open are essentially disjoint from the times when the European markets are open, are essentially disjoint from the times when the Asian markets are open. So even using daily data has problems, but using much shorter horizon data, you simply can't do it because while you may know that a particular stock rose in value between 3 and 315 in New York, you have no information on prices of stocks in Europe or in Asia at that time. So you simply can't get started. So that's the limitation. This works very well, I think, for stocks of a single country, it doesn't seem to help very much as far as we can tell if you want to look at global markets. Now, the other thing you might do is identify regimes with a market switching model, and I'm going to argue that that is not the right thing to do with volatility regimes. And part of the reason is that volatility is changing constantly. So you can't really say there are two regimes and estimate I'm in the volatile regime or a quiet regime. You know, you need a large number of regimes. You can't estimate which one you're in. If I look at a year's worth of data and split it into 4 different regimes, and each one is roughly 60 days, I don't have enough data to estimate any one of the regimes. And most important, I'm going to argue that it's not necessary. Basically, what you can do is naively run PCA over the whole period of a year, and if the only thing that's going on is that volatilities of factors are changing, PCA works just fine. It will estimate the factors. It is a little bit noisier when the market volatility is changing than when the volatility is constant, but basically it works fine. So we propose an alternative for dealing with variable volatility, and it's conceptually related to the use of the quadratic covariation and the work that's done with intraday data. I'm going to also identify an approach to dealing with non-Gaussian return distributions. So I said the most visible thing about financial data is that its volatility is changing all the time. And probably the second most visible thing is that returns aren't Gaussian. Okay, you very quickly reject the assumption that they're Gaussian. Even the assumption that they're conditionally Gaussian with variable volatility you can reject pretty easily. And we're going to see that we may be able to do something about that. And I may or may not get time to this, but I'm also have some results to talk about strengths and weaknesses of using PCA to estimate data that contains differing regimes, not just in the volatility sense, but the market's really different on some periods. Okay, so what's the variable volatility formulation? So I've got K constant volatility factors. Okay, emphasize constant volatility. These are going to be the building blocks of the model. And their covariance matrix is the identity, and these are ID across time. Okay? And I'm going to assume that the return distribution for the factors is parameterized, well, I say here by a single scale factor. It could be also by a scale factor and a location, a scale parameter and a, so it shouldn't be scale factor, it should be scale parameter. There could also be a location parameter. But since we're talking about daily returns of stocks, the mean return is it's much better for us to set that to 0 than to try to estimate it and use it in the model. So in fact, we'll focus on the scale parameter. And aside from that, they need not be Gaussian. So for example, any power law, there's a scale factor in it. If you have a distribution which is power law in the tails only, actually those are probably the things that are most interesting in finance because things may look fairly Gaussian in the center and then they may be power laws in the tails and you can't fit the whole thing into a single power law. But if you have power law in the tails, that's going to be reasonably okay also for the things we want to look at. And then we've got a volatility process, V, which takes values in RK. So V at any given day is going to be the volatility that day of each of the K factors. And we need to assume that's independent of the constant volatility factors. And probably the most useful model to have in mind is that it's generated by a standard finance model called the Heston model. This is, roughly speaking, an Ornstein-Uhlenbeck process. So we've got some normal level of volatility. We have a Brownian motion, which is driving the volatility up or down in a random way, but then we have a drift back towards the long-run average. Okay, so for technical reasons, they don't exactly use an Ornstein-Uhlenbeck process, but it has that basic form, and it gives you a process describing evolution of volatility in the market. Okay, and then our variable volatilities factors, phi, are going to be derived from the phi tildes by, on each day, I take a given factor and multiply that factor by what my Heston process or other process generating V tells me is the volatility for that factor on that day. So if in fact V is a Heston process, what this means is that the volatility of each factor is going to move up and down. It will, its change on a given day will be random. It could be up or down. The changes are IID, but it's always drifting back towards some long-term average volatility. And we can make various assumptions about how the volatility processes for different factors are related. And finally, the idiosyncratic volatility. So remember, there's going to be some returns of the stocks that are not explained by the factors, that they're just specific to what's going on in the stock. And again, those can have variable volatility. They need to in order to make the model look like the market. So what's the conceptual idea? Well, if you look at the n by n asset covariance matrix, it has the form x transpose qx, where remember x is the vector of loadings, of sensitivities of the stocks to the individual factors. And this q has a natural form. It's actually phi transpose phi over t. So that's the realized covariance matrix of the factor returns. Okay, now the factor returns, before we applied the variable volatility, were orthogonal to each other. That's in the population, but of course here we've applied the variable volatility, and also, perhaps more importantly, we're looking at a finite sample. So this matrix is going to look roughly diagonal, but the off-diagonal entries will not be exactly zero. They'll be relatively close to zero. And this thing is the discrete analog of the quadratic covariation matrix that drives the results for high-frequency data. And this is what Q looks like. Basically, it's, as I said, it's almost diagonal. It's close to a diagonal matrix D. And the entries in the diagonal are actually just the realized variance of the factors. So you can't observe the factor returns, but if you could observe them, you could just calculate what's the realized variance over the course of the period you're looking at, and you stick those on the diagonals, and that's the form that the n by n covariance matrix takes. And we don't need to assume that D converges in any sense. It's just this object, and it will be a different object over the course of next year than it is this year. It's constantly evolving over time, but this tells us about the eigenvectors of the n by n matrix. In particular, the rows of x are eigenvectors of x transpose dx, and therefore they're approximate eigenvectors of this matrix, which is close to x transpose dx. So PCA correctly identifies the factor sensitivities even with variable factor volatility. Okay, and this is true even though changing volatility changes the correlations of assets. So the asset correlation matrix is changing all the time, but the eigenvectors we estimate, we get convergence to what we want. Okay, let me introduce one other idea. So I want to look at, this is absolutely standard PCA, okay? But there's a little twist in it, which we add, which is we use PCA over the whole period to estimate the factor loadings, and we don't try to separate into different volatility regimes, but we get two sets of eigenvectors. The eigenvectors of the n by n matrix are estimates of the factor sensitivities, and the eigenvectors of the k by k matrix are estimates of the time series of the factor profit loss. And we combine these two. Our factors come from the n by n matrix, but their estimated volatilities come from an exponentially weighted standard deviation of the estimated factor returns. So basically we take a half-life, and it's typically around 40 days, something of that order works best, estimate the standard deviation over that 40-day half-life of the eigenvectors of the k by k matrix, and then use that to impute the volatility of the factors. So that's what I mean by responsive volatility adjustment. And here's a summary of what we find in simulation. So these are all simulation results, but it's in a relatively robust model where we can change parameters in many ways. We can change all the parameters independently. So we've run this over a lot of specifications, and a bunch of things come out. The first is that the errors in predictions of portfolio volatility are modestly higher when volatility is variable than in the constant case, but only modestly. We can estimate the variability we can estimate the volatility of portfolios reasonably well. The errors in the estimated factor loadings, the news is not quite as good. They're higher, although whether the amount of the increase is enough to be concerned about is something that we need to work some more on. Now, once you get a volatility estimate, and as I said, we can get good volatility estimates, then if you assume your factor returns are Gaussian, you get by formula two important notions. One is value at risk, and the other is expected tail loss. So value at risk means the lower 3% quantile of return. So I want to predict, if I had 100 observations of tomorrow's return, what am I going to find is the 3% quantile that's lowest. Okay, and if I use a Gaussian estimate, I substantially underpredict risk in the presence of negative skewness. And Gaussian estimates of expected tail loss substantially underpredict risk in the presence of negative skewness and or excess kurtosis, both of which are demonstrably present in stock returns. Okay, and we have a method to correct for these two things, which is to look at the history of z-scores. So I have a volatility estimate, prediction. I can look at, in the past, what the actual return was divided by the volatility prediction and view that as a z-score. And I can use that in order to estimate the distribution of value at risk and expected tail loss out of sample in the future, given my pretty good volatility predictions. So I'm running out of time, so let me skip to a table. So this table I won't talk about. This is the one that argues that the bias estimates with variable volatility are really not any worse than those with constant volatility if you use the right half-life. Also has information about the estimates of the factor sensitivities. Let me go to this table. So in this case, we've got 4 cases. In this table, we've got 4 cases. We've got, Gaussian factor returns with constant volatility, Gaussian returns with variable volatility. Student T, it's 6 degrees of freedom, so that has excess kurtosis 3 and variable volatility, and a skewed Gaussian with variable volatility. And in the next 2 columns, we've got the Gaussian predictions of value at risk and expected tail loss. And so we take the predicted value at risk and then say, what fraction of the days do you exceed it? The answer ought to be 3%. And you can see with constant volatility, you get it dead on. But with variable volatility, you're getting more value at risk exceedances than you would ideally like. And you are also with excess kurtosis. But when you have a negative skew, the thing really blows up. You're expecting it to exceed at 3% of the time. You're getting almost 4.5. So you're getting almost 50% more exceedances than you would want to have. And if you look at the expected tail loss ratio, with the skew, it's 25% bigger than you predict. But with the historical method, you see the VAR exceedances are all very, very close to 3%. In these rows, they're all slightly under 3%, and I think that's an artifact. I drew 50,000 observations, and I think if I'd drawn a different 50,000, I might have gotten a little over 3. I don't think the fact they're under 3 is significant. But look at the expected tail loss ratio. So you'd like this to be -1, and it damn near is -1, except in the last row, the skew case, where it's the magnitude is much less than 1. And what that's saying is that this method is over-predicting expected tail loss. So the Gaussian method tends to under-predict risk. The historical method does an excellent job of predicting risk, except in the presence of skewness, where it seems to over-predict it. And we're thinking about ways to address that over-prediction. But in general, for a financial manager looking at this, over-predicting risk is not desirable, but it's much better than under-predicting risk. So minus 0.725 is a much better number than minus 1.252. You want to protect yourself against under-predicting risk. You'd prefer not to over-predict it, but you care more about avoiding under-predictions. And I'm out of time. I'm actually a little bit over, so I'll stop.